Tap Dancing to Work. Warren Buffett on Practically Everything, 1966 to 2012. A Fortune magazine book by Carol J. Loomis. Narrated by Susan Boyce and Barry Press. Preface. Because I have long been the chief writer about Warren Buffett at Fortune, which for decades has covered him more closely than any other business publication, I have often been asked whether I am going to branch out and write a Buffett biography. I have always said no, sure beyond a doubt that a writer who is a good friend of the subject does not make a good biographer. And I have indeed been a close friend of Warren's for more than 40 years, a shareholder in his company, Berkshire Hathaway, for almost that long, and the pro bono editor of his annual letter to shareholders for 35. All of those facts can be accommodated in my Fortune articles about Buffett, simply by my informing the reader that they exist. But they are not a firm base for a wide-ranging personal and professional biography, in which there should be considerable distance between writer and subject. Its absence in this case settled the question. But then it dawned on me that the scores of Buffett articles we have published in Fortune are in themselves a business biography, and a perfect one for a book. Here you have it. Tap Dancing to Work, the description that Buffett has long applied to his love for running Berkshire. This book is a collection, arranged chronologically for the most part, of all our big articles about Warren, plus some shorter, lighter ones like Are Jimmy and Warren Buffett Related? For each of the big stories I've written an introduction or commentary, about 40 of them in total. These paragraphs explain, for example, what's particularly important about the story, what Warren forecasts that did or didn't come true, what he thinks today about the story's main point. Overall, the book's material covers a large chunk of history, 46 years, an important span of time, not only for Buffett, but for the U.S. economy in which he has so successfully operated. 46 years, Buffett would be inclined to say. That's a long time. Almost 1/5 of the years the U.S. has existed. The articles and excerpts in this book were for the most part written by me and about 40 other Fortune journalists, including 3, John Huey, Rick Kirkland, and Andy Serwer, who rose to managing editor, with John subsequently moving still higher to the post of Time Inc.'s editor-in-chief. But the authors also include Buffett himself, who wrote 2 important stories expressly for us and inserted think piece sections into his annual letters that we lifted out and made into stories. Also represented is that well-known business writer, Bill Gates. In content as well as authors, this book is enormously diverse. We had the good sense along the way not to repeat ourselves too much, and when we did, I normally edited out the repetition. Actually, not repeating ourselves was pretty easy, because Warren kept doing new things. When you finish this book, you will have seen the arc of Warren's business life. The first story in which we ever mentioned him was in 1966. He got 1 sentence, then, an investing piece that I wrote about another man, Alfred Winslow Jones, and in which I misspelled Buffett, giving it only 1 T. I will try, however, weakly to pardon myself for that by saying that outside Omaha, where a few investors knew Warren well because he was making them rich, he was in 1966 pretty much unknown. Jump to the early 1980s, and he hadn't gained much ground. When Fortune hired freelancer Andrew Tobias in 1983 to write a piece about Buffett's shareholder letters, Tobias had never heard of this fellow. That means, alas, that Tobias had missed the big story about inflation that Warren wrote for us in 1977, and about which he still gets mail. The middle part of the book, starting with my 1988 profile, The Inside Story of Warren Buffett, describes his adding a second profession, business management, to his old one of investor. And next, of course, he made Berkshire Hathaway a huge force in corporate America. Few people recognize the insignificance from which that company has come. In 1965, when Warren took it over, Berkshire was a New England textile manufacturer, far too small to have made the Fortune 500 list. For 2011, in contrast, it was number 7 on the 500. That rank is for revenues, which is the 500's primary criterion. In market value, a higher accomplishment in Buffett's thinking, Berkshire was number 9. And all that has happened in one man's lifetime, which of course is not over. The final years covered by the book complete the arc, so to speak, by taking Warren beyond investing and business to philanthropy. This step did not require him to invent a philosophy. He has never believed in large inheritances, and almost all of his money has always been slated to go to philanthropy. But he had always assumed that his wife, Susie, 2 years younger, would outlive him and be the one who gave away his money. Susie then died of a stroke in 2004, and the philanthropy yoke settled back, none too lightly, on Warren. Thus came his announcement in 2006 that he would start to give away his money immediately. In his 2010 move with Bill and Melinda Gates to create the Giving Pledge, Fortune broke the news in each instance, in cover stories that appear toward the end of this book. You can take the man out of investing, but you cannot take investing out of this man, for sure. The final story in this book, adapted from Warren's letter in the 2011 annual report, explains the 3 types of investments and the one he prefers. There won't be any great surprise in his choice, but a new dose of Buffett investment advice as you finish the book can't be all bad. For me, compiling this book has been a trek through my own career at Fortune, 1954 to still happening, and through endless warnings as well to put 2 T's on Buffett. More significantly, it has been an extended and rewarding reminder of Buffett's investment and business genius, creativeness, and, not the least of these, consistency of thought. A friend of well-known writer William Buckley made a statement about him that I will adapt here. Fortune and I were lucky to be standing alongside Warren Buffett as he was becoming Warren Buffett. The Joneses Nobody Keeps Up With, April 1966, by Carol Loomis. It may be odd to start a book about one man, Warren Buffett, with an article about another, Alfred Winslow Jones. But this 1966 piece about Jones deserves the lead-off position. To begin with, this is the first time that Fortune mentioned the name Buffett, except that we embarrassingly spelled it Buffett with only 1 T. I made that mistake. Yours truly, Carol Loomis, the editor of this book and the author of many of the articles in it, including this one. Later, my husband, John Loomis, then an institutional securities salesman, met Buffett, who shortly after called me up to kid me a bit about the misspelling. Further on, he and his wife Susie asked John and me to have lunch in New York. And they and we began a friendship that in time, you might say, led to this book. A second point about the article is that it rather famously introduced A.W. Jones and his concept of a hedged fund to the world. Not that Jones was the first Wall Streeter to establish such a fund. Benjamin Graham, for one, had earlier run a partnership that used hedging strategies. But Jones's skyrocketing success was a revelation to most Fortune readers, and this article took on a life of its own, becoming an unofficial prospectus for many people who hastened to start Jones-type funds of their own. Histories of the hedge fund industry almost always refer to this article as a milestone in that world's development. Close readers of the article may note the tentativeness of the first sentence. "There are reasons to believe" is hardly a ringing declaration. The explanation, of course, is that though I had the record of private investor A.W. Jones and Company and had discovered none better, my knowledge of how other private investors were doing was certainly not complete. Had the record of Omaha's Buffett Partnership Limited been then in our hands, a matchup of Buffett and Jones would have been interesting but hardly conclusive. We had a 10-year record of A.W. Jones and Company, but Buffett Partnership kept its books on the calendar year and had only 9 of those behind it. As for 5 years, Jones ended his 1965 fiscal year in May and for the period made 325%. Buffett's 1965 year ended in December, and he made 334%. But all that was history, and the paths of the two men soon diverged. As the next article discusses, Buffett closed down his partnership, while Jones stayed on to struggle with a stock market grown, for the moment, very difficult for hedge funds. CL. There are reasons to believe that the best professional manager of investors' money these days is a quiet-spoken, seldom photographed man named Alfred Winslow Jones. Few businessmen have heard of him, although some with long memories may remember his articles in Fortune. He was a staff writer in the early 1940s. In any case, his performance in the stock market in recent years has made him one of the wonders of Wall Street, and made millionaires of several of his investors. On investments left with him during the 5 years ended last May 31, when he closed his 1965 fiscal year, Jones made 325%. Fidelity Trend Fund, which had the best record of any mutual fund during those years, made only 225%. For the 10-year period ended in May, Jones made 670%. Dreyfus Fund, the leader among mutual funds that were in business all during that decade, had a 358% gain. The vehicle through which Jones operates is not a mutual fund, but a limited partnership. Jones runs 2 such partnerships, and they have slightly different investment objectives. In each case, however, the underlying investment strategy is the same. The fund's capital is both leveraged and hedged. The leverage arises from the fact that the fund margins itself to the hilt. The hedge is provided by short positions. These are always some of the fund's portfolio. There are about 60 investors in each of the 2 funds, and their average investment now works out to about $460,000. Jones's accomplishments have spawned a number of other hedge funds. In the last 2 years, 2 of Jones's principal associates have left his organization and set up limited partnerships of their own. One is known as City Associates. It has capital of about $17,500,000. The other as Fairfield Partners, $14 million. Both have had outstanding performance records. This month, a new partnership, Fleshner Becker Associates, will go into business as a hedge fund. Its principals are Wall Street brokers who have done business with Jones over the last few years. Besides these partnerships, a number of other hedge funds are operating on a small scale. In addition, a small brokerage firm named L. Hubschman & Company, which has also done business with Jones, has bypassed the partnership pattern and is setting up an open-end investment company, i.e., a mutual fund, the Hubschman Fund, which will invest on hedge fund principles. It remains to be seen whether a regulated investment company can use Jones's techniques as effectively as a private partnership does. Meanwhile, Hubschman's move opens the way for a large number of investors to buy themselves a stake in the hedge fund idea. For most of his life, Jones, who is now 65, was more interested in sociology and in writing than he was in the stock market. In 1938, he set out to get his Ph.D. in sociology at Columbia University. While working toward the degree, he served as director of Columbia's Institute for Applied Social Analysis and undertook for it a major project on class distinctions in the U.S. The project became the basis for his doctoral thesis, which was published under the title Life, Liberty, and Property. 2 years ago, it was reprinted by Octagon Books, Inc. Fortune asked Jones to condense the book into an article, February 1941, and hired him as a writer. Over the next 5 years, part of it spent with time, he wrote articles on such non-financial subjects as Atlantic convoys, farm cooperatives, and boys' prep schools. He left Time Inc. in 1946, but in March 1949 he was back in the pages of Fortune with a freelance article, Fashions in Forecasting, which reported on various technical approaches to the stock market. His research for this story convinced him that he could make a living in the stock market, and early in 1949 he and 4 friends formed A.W. Jones and Company as a general partnership. Their initial capital was $100,000, of which Jones himself put up $40,000. In its first year, the partnership's gain on its capital came to a satisfactory 17.3%. But this was only a suggestion of things to come. Not quite all the original capital had been left in the partnership, but if it had been, it would today be worth $4,920,789, before any allowance for the partners' taxes. In the early years, Jones was experimenting with a number of investment approaches, including the hedge idea, which was essentially his own. Increasingly, he began to concentrate on refining and employing this new technique. In effect, the hedge concept puts Jones in a position to make money on both rising and falling stocks, and also partially shelters him if he misjudges the general trend of the market. He assumes that a prudent investor wants to protect part of his capital from such misjudgments. Most investors would build their defenses around cash reserves or bonds, but Jones protects himself by selling short. To those investors who regard short selling with suspicion, Jones would simply say that he is using speculative techniques for conservative ends. As illustration, he is given to contrasting his methods with those of an investor who has, say, $100,000 and elects to invest $80,000 of it in stocks and the rest in safe bonds. Jones would use the $100,000 to borrow perhaps another $50,000. Under the current margin requirements of 70%, he could not borrow that much to buy listed stocks. However, he could borrow even more than $50,000 for purchases of convertible bonds and unlisted stocks. Of the $150,000 total, he might put $110,000 into stocks he likes and sell short $40,000 worth of stocks he thinks are overvalued. Thus he ends up with $40,000 of his long position hedged, i.e. offset by a short position, and the remaining $70,000 fully exposed. This figure represents 70% of his original capital, and Jones therefore describes his risk as 70. In practice, there is an added complication. Jones adjusts the dollar figures in a calculation that assumes some individual stocks to be more volatile and therefore more risky than others. Every stock in Jones's portfolio is assigned a velocity rating. For example, Syntex's is 6.61, Kerr-McGee's 1.72. And the dollars invested are multiplied by these factors. The adjusted dollars are then used to figure the risk. By Jones's method of measuring, the more conventional investor who puts $20,000 into bonds, neither borrowing nor selling short, had a risk of 80. If the stock market goes down by 10%, and all stocks in these two portfolios do likewise, Jones will break even on the hedged part of his portfolio and will lose less on his unhedged position, $7,000 instead of $8,000 than the other investor. If the stocks all rise by 10%, Jones will make less than the other investor. His problem, therefore, is to buy stocks that will rise more than the general market and sell stocks short that will rise less than the averages, or will actually fall. If he succeeds in this effort, his rewards are multiplied because he is employing not just a portion of his capital, but 150% of it. The main advantage of the hedge concept, then, is that the investor's short position enables him to operate on the long side with maximum aggressiveness. Jones's record in forecasting the direction of the market seems to have been only fair. In the early part of 1962, he had his investors in a high-risk position of 140. As the market declined, he gradually increased his short position, but not as quickly as he should have. His losses that spring were heavy, and his investors ended up with a small loss for the fiscal year. This is the only losing year in Jones's history. After the break, furthermore, he turned bearish, and so did not at first benefit from the market's recovery. Last year, as it happened, Jones remained quite bullish through the May and June decline, and then got bearish just about the time the big rally began. As prices rose in August, Jones actually moved to a -18 risk, i.e., his short positions exceeded his longs, with the unhedged short position amounting to 18% of the partnership capital. Despite these miscalculations about the direction of the market, Jones's selections of individual stocks have generally been brilliant. When he finally did turn bullish in the fall, he was long on a lot of the right stocks. For example, Syntex, National Video, Fairchild Camera, the airlines. By the end of February, he had racked up gains for the fiscal year of 38% in one fund, 31% in the other, compared to an increase, including dividends, of 6% for the Dow Jones Industrials. Any hedge fund operator will explain that although the hedge concept is essential, "I need it to sleep nights," says one of them, the real secret of his success is his ability to get good information about stocks and to be able to act on it quickly. The partnership form of organization is helpful in both respects, and it is worth examining Jones's arrangements closely. Jones changed his firm from a general to a limited partnership in 1952 in order to accommodate several friends who were by then eager to have him handle their money. The new partners were let in on the understanding that they could withdraw their money from the partnership or put new money into it only at the end of each fiscal year. This agreement still exists. Moreover, Jones and the other general partners are to receive as compensation 20% of any realized profits, after deduction of realized losses, made on the limited partners' money. This arrangement is common to all the hedge funds, and the idea was not original with Jones. Benjamin Graham, for one, had once run a limited partnership along these same lines. There are also some mutual funds today. For example, Oppenheimer Fund, Equity Fund, Leon B. Allen Fund, whose managers are paid on the basis of profits, although less liberally than Jones. The Hubschman Fund will have a similar arrangement. The limited partners would seem to have no cause for complaint about the huge profits realized by Jones. Those sensational comparative performance figures reflect the limited partners' results after deduction of the general partner's share of their profits. In other words, the figures understate Jones's actual superiority over Fidelity Trend and Dreyfus in portfolio performance. It is small wonder, then, that as the years have gone by, a lot of investors have sought to get into Jones's partnerships. But since they are organized as private, unregistered funds, Jones took in only a few additional partners each year, primarily investors who were relatives or close friends of existing partners. By now, however, the partners have got to be a diverse group. The largest limited partnership interest belongs to Louis E. Stevens, a Mexico City businessman. He is the retired general manager of General Products S.A., a chemical company, who had $2.26 million in one Jones partnership at the start of this fiscal year. Another large stake is held by A. Arlie Sineco, a physician turned professional sculptor, who, together with his family, has about $2 million invested with Jones. Most of this amount represents portfolio appreciation. Several of the Richardsons associated with Richardson Merrill, including the company's chairman, Smith Richardson, Jr., have money in the partnerships. So does Louis Fisher, author of The Life of Lenin and other books, and Samuel Stayman, the bridge expert. Stayman, whose wealth comes primarily from a woolen business, also has money in the two other big hedge funds, City Associates and Fairfield Partners, and in Buffett Partnership Limited, a $45 million Omaha operation that uses hedge principles to some extent, but that has mainly, and very successfully, concentrated on long-term investment. Other prominent businessmen in the hedge funds are Lawrence Tisch, president of Loews Theaters, and Maurice Pearlstein, ex-president of Kellwood Company. All told, Jones's limited partners had an investment with him of $44,898,000 as of June 1st. Of this amount, about $5 million represented investments by the immediate families of the 10 general partners. In addition, the general partners themselves, who have agreed to keep all of their investment funds in the partnership, had another $5 million invested. Of this, about $2 million is Jones's own. His two children, both of them limited partners, have another $2.5 million together. In total, including the gains he has made so far this fiscal year, Jones is managing close to $70 million of capital. Even with the borrowed money added in, this makes his operation no bigger than a medium-sized mutual fund. But the weight Jones swings on Wall Street is many times magnified by the fact that, like all hedge fund operators, he is a prodigious producer of commissions. Since short sales can never result in anything but short-term gains or losses, the hedge operator moves in and out of them freely. Similarly, when he has losses on the short sales, he also finds it easier to take offsetting short-term gains on long positions. In general, the hedge funds have a high portfolio turnover. One big reason the hedge funds find it natural to move in and out of stocks a lot is that, far more than most other funds, they have a special ability to get a flow of good, fresh ideas about stocks from brokers and get them early. Most mutual funds are virtually compelled to channel a large proportion, perhaps as much as 90%, of the commissions they generate to brokers who sell the shares of their fund to the public. They have very little commission business left over for any firms that are unimportant in mutual fund sales, but that are strong on research. The partnership funds, on the other hand, have no shares to sell, and thus can afford to pay a generous portion of their commissions for research. In Jones's case, the payments take a roundabout form. The brokerage firm of Neuberger and Berman executes practically all Jones's orders, but keeps only about 50% of the commissions generated. It sends the remaining 50% in the form of give-up checks to brokers designated by Jones. A brokerage firm that Jones relies on heavily for research may get possibly $50,000 in give-ups a year, of which a third or more might go to the salesman who was covering the account and supplying those good ideas. That salesman is therefore likely to be very cooperative about keeping Jones informed. The Jones organization is set up so that decisions about purchases and sales can be made immediately without committee consultation. There are 5 portfolio managers, all general partners, each of whom has discretion over a percentage of the partnership capital. In addition, several outside advisors, one of them an investment counselor, the rest brokerage house analysts or salesmen, have been given blocks of capital to manage. Either Jones or his number 2 man, Donald Woodward, sees each order before it is executed, but they interfere only when it seems to them that the partnership is getting overloaded with a given stock. For example, if several of the portfolio managers are being sold on the stock at the same time, or is maneuvering itself into an undesirable risk position. The portfolio managers will tell you that, given the long-term trend of the market upward, their most difficult job is picking good short sales. Wall Street's analysts typically concentrate on discovering bullish corporate situations, and only rarely have promising shorts to bring to Jones. As a result, he and the other hedge fund managers normally consider themselves lucky to break even on their short portfolios. Early last month, Jones was short about 60 different stocks, including Corvette, Bristol-Myers, Admiral, and DuPont. All of the big hedge funds were short control data. Recently, Jones has devoted more and more time to traveling and philanthropic projects, many of them financed by his own foundation for voluntary service. He has made some field trips for the Peace Corps, and his own foundation is currently supporting the activities in this country of 5 young social workers from India, as a sort of reverse Peace Corps. He is also thinking of writing another book on what to do about poverty in the U.S. From Hard Times Come to the Hedge Funds, January 1970. An excerpt from an article by Carol Loomis. After years of extravagant profits, many gained in the wildly speculative market of 1968. The fledgling hedge fund industry was hammered in 1969 by a rough bear market. The hedging strategies that were supposed to protect the funds largely failed. Most funds showed losses, some suffered large withdrawals of capital, and a few folded. In contrast, Buffett Partnership, the subject of a short section in this article, made money in 1969. Adding to its unbroken string of profits. The fund had meanwhile grown big, to $100 million in assets, versus the $160 million divided between 2 funds that A.W. Jones ran. But Warren Buffett, then 39, was hardly happy with this world. He regarded the speculative excesses of 1968 as insane. "This is a market I don't understand," he said. He also suspected that making money in stocks was going to become harder to do. So he announced in 1969 that, after 13 years of operation, he would close Buffett Partnership at the end of the year. That point starts off the article's 2 paragraphs about Buffett, which we reprint here. His excerpt also reports the outstanding returns that Buffett delivered his limited partners, a compounded annual return for the 13 years of 23.8%. The fund's gross record, that is, before Buffett took his incentive compensation, was naturally still more stunning, a compounded annual return of 29.5%, against a comparable total return for the Dow of 7.4%. Buffett himself accumulated a fortune of about $25 million from running the partnership. Buffett's reasoning as to why he should close the partnership turned out to be less on the money. True, over the near term the stock market ran into tough times, particularly in 1973 and 1974. But stocks, of course, proceeded over the decades to reward investors handsomely. Fortunately for Buffett, and for the investors who followed him, he stayed in the market as chief executive of Berkshire Hathaway and master investor of its excess cash. Buffett's other stated reason for closing up shop, that it was time to stop amassing money and get on to other things, simply faded into unreality. It wasn't the money that drove him on. To this day, he leads an unostentatious life. But building wealth has, to him, been an endlessly fascinating game. One inning of that game ended as he closed the partnership. The others commenced as he settled back to running Berkshire. C.L. The arrival of 1970 will mark not only the demise of certain unsuccessful hedge funds and the constriction of still others, but will also bring the liquidation of one of the country's oldest, largest, and most successful investment partnerships, Buffett Partnership Limited of Omaha. To call the Buffett operation a hedge fund is accurate only in the sense that Warren E. Buffett, 39, the general partner, shares in the profits of the limited partners. Under his quite unusual arrangement, the limited partners keep all of the annual gains up to 6%. Above that level, Buffett takes a 1/4 cut. Otherwise, he is set apart from the regular hedge funds by the fact that he has invested almost exclusively in long-term value situations. Buffett's record has been extraordinarily good. In his 13 years of operation, all of them, including 1969, profitable. He compounded his investors' money at a 24% annual rate. But now, to the immense regret of his limited partners, Buffett is quitting the game. His reasons for doing so are several, and include a strong feeling that his time and money, he is a millionaire many times over, should now be directed toward other goals than simply the making of more money. But he also suspects that some of the juice has gone out of the stock market, and that sizable gains are in the future going to be very hard to come by. Consequently, he has suggested to his investors that they may want to take the passive way out, investing their partnership money not in the stock market, but rather municipal bonds. The full text of Hard Times Come to the Hedge Funds is available at fortune.com/BuffettBook. How Inflation Swindles the Equity Investor. May 1977, by Warren Buffett. This book contains 12 articles authored by Warren Buffett. 2 are pieces that he wrote expressly for Fortune, the first of which follows. The others are 2 major speeches of his that we turned into articles, an important letter he sent to a congressman, his philanthropic pledge, and 6 excerpts from his annual Berkshire letter. For this article, the inaugural piece of the 12, a senior and very talented Fortune editor, Dan Siegelman, made a trip to Omaha to negotiate with Buffett about revisions to his first draft. Siegelman found this $1-an-article writer generally resistant to shortening the piece and not too amenable to changes of any kind. At one point, a frustrated Siegelman called Fortune's managing editor, Bob Lubar, to suggest that perhaps the magazine should not publish the article at all. But Lubar said he thought the article was worthwhile and should not be abandoned. The article that emerged, no doubt reflecting at least some Siegelman edits, was an early example of Buffett's extraordinary talent for thinking through complicated problems. To this day, the article is remembered for its erudition. Both Buffett and Fortune still get letters about it, commenting on one aspect or another. Nevertheless, the piece turned out to be wrong in several ways. First, Buffett, along with the business world in general, thought high inflation rates were here to stay and would plague investors. What he would not foresee was the genius and resolve of Paul Volcker, who took over as Fed chairman in 1979 and broke the back of inflation. Second, Buffett misjudged the course of corporate tax rates, which he thought were unlikely to fall. In reality, a succession of tax cuts beginning in 1979 brought the marginal rate down from the 48% prevailing when the article was written to 35% today. That helps explain why Buffett also erred in believing that the return on equity of major corporations would continue to be stuck around 12%. By 1981, I was writing an article titled "Profitability Breaks Through a Ceiling," which reported that the median return for the Fortune 500 over the previous 5 years had, despite high rates of inflation, leaped to an average of 14.8%. The article attributed the jump to corporations increasing their leverage a bit, enjoying reduced tax rates, and managing to raise their pre-tax profit margins. Today, Buffett says that had capitalism worked perfectly, competition would have kept profit margins down. Nonetheless, he adds, you can't get around it. I was wrong in my assumptions, particularly about tax rates. He remains convinced, however, that high rates of inflation are sure to swindle the equity investor, and he cites evidence from the years when inflation was out of control. Until Volcker pushed inflation below 8% in 1982, Buffett recalls investors who bought stocks in 1977 had suffered a clear-cut loss in purchasing power. CL.
It is no longer a secret that stocks, like bonds, do poorly in an inflationary environment. We've been in such an environment for most of the past decade, and it has indeed been a time of troubles for stocks. But the reasons for the stock market's problems in this period are still imperfectly understood. There is no mystery at all about the problems of bondholders in an era of inflation. When the value of the dollar deteriorates month after month, a security with income and principal payments denominated in those dollars isn't going to be a big winner. You hardly need a PhD in economics to figure that one out. It was long assumed that stocks were something else. For many years, the conventional wisdom insisted that stocks were a hedge against inflation. The proposition was rooted in the fact that stocks are not claims against dollars as bonds are, but represent ownership of companies with productive facilities. These, investors believed, would retain their value in real terms, let the politicians print money as they might. And why didn't it turn out that way? The main reason, I believe, is that stocks in economic substance are really very similar to bonds. I know that this belief will seem eccentric to many investors. They will immediately observe that the return on a bond, the coupon, is fixed, while the return on an equity investment, the company's earnings, can vary substantially from one year to another. True enough. But anyone who examines the aggregate returns that have been earned by companies during the post-war years will discover something extraordinary. The returns on equity have, in fact, not varied much at all. In the first 10 years after the war, the decade ending in 1955, the Dow Jones Industrials had an average annual return on year-end equity of 12.8%. In the second decade, the figure was 10.1%. In the third decade, it was 10.9%. Data for a larger universe, the Fortune 500, whose history goes back only to the mid-1950s, indicates somewhat similar results: 11.2% in the decade ending in 1965, 11.8% in the decade through 1975. The figures for a few exceptional years have been substantially higher. The high for the 500 was 14.1% in 1974, or lower, 9.5% in 1958 and 1970. But over the years, and in the aggregate, the return on book value tends to keep coming back to a level around 12%. It shows no signs of exceeding that level significantly in inflationary years, or in years of stable prices for that matter. For the moment, Let's think of those companies not as listed stocks, but as productive enterprises. Let's also assume that the owners of those enterprises have acquired them at book value. In that case, their own return would have been around 12% too. And because the return has been so consistent, it seems reasonable to think of it as an equity coupon. In the real world, of course, investors in stocks don't just buy and hold. Instead, many try to outwit their fellow investors in order to maximize their own proportions of corporate earnings. This thrashing about, obviously fruitless in the aggregate, has no impact on the equity coupon, but reduces the investor's portion of it, because he incurs substantial frictional costs, such as advisory fees and brokerage charges. Throw in an active options market, which adds nothing to the productivity of American enterprise, but requires a cast of thousands to man the casino, and frictional costs rise further. It is also true that in the real world, investors in stocks don't usually get to buy at book value. Sometimes they have been able to buy in below book. Usually, however, they've had to pay more than book, and when that happens, there is further pressure on that 12%. I'll talk more about these relationships later. Meanwhile, let's focus on the main point. As inflation has increased, the return on equity capital has not. Essentially, those who buy equities receive securities with an underlying fixed return, just like those who buy bonds. Of course, there are some important differences between the bond and stock forms. For openers, bonds eventually come due. It may require a long wait, but eventually the bond investor gets to renegotiate the terms of his contract. If current and prospective rates of inflation make his old coupon look inadequate, he can refuse to play further unless coupons currently being offered rekindle his interest. Something of this sort has been going on in recent years. Stocks, on the other hand, are perpetual. They have a maturity date of infinity. Investors in stocks are stuck with whatever return corporate America happens to earn. If corporate America is destined to earn 12%, then that is the level investors must learn to live with. As a group, stock investors can neither opt out nor renegotiate. In the aggregate, their commitment is actually increasing. Individual companies can be sold or liquidated, and corporations can repurchase their own shares. On balance, however, new equity flotations and retained earnings guarantee that the equity capital locked up in the corporate system will increase. So, score one for the bond form. Bond coupons eventually will be renegotiated. Equity coupons won't. It is true, of course, that for a long time a 12% coupon did not appear in need of a whole lot of correction. There is another major difference between the garden variety of bond and our new exotic 12% equity bond that comes to the Wall Street costume ball dressed in a stock certificate. In the usual case, a bond investor receives his entire coupon in cash and is left to reinvest it as best he can. Our stock investor's equity coupon, in contrast, is partially retained by the company and is reinvested at whatever rates the company happens to be earning. In other words, going back to our corporate universe, part of the 12% earned annually is paid out in dividends, and the balance is put right back into the universe to earn 12% also. This characteristic of stocks, the reinvestment of part of the coupon, can be good or bad news depending on the relative attractiveness of that 12%. The news was very good indeed in the 1950s and early 1960s, with bonds yielding only 3 or 4%. The right to reinvest automatically a portion of the equity coupon at 12% was of enormous value. Note that investors could not just invest their own money and get that 12% return. Stock prices in this period ranged far above book value. and investors were prevented by the premium prices they had to pay from directly extracting out of the underlying corporate universe whatever rate that universe was earning. You can't pay far above par for a 12% bond and earn 12% for yourself. But on their retained earnings, investors could earn 12%. In effect, earnings retention allowed investors to buy at book value part of an enterprise that, in the economic environment then existing, was worth a great deal more than book value. It was a situation that left very little to be said for cash dividends and a lot to be said for earnings retention. Indeed, the more money that investors thought likely to be reinvested at the 12% rate, the more valuable they considered their reinvestment privilege, and the more they were willing to pay for it. In the early 1960s, investors eagerly paid top-scale prices for electric utilities situated in growth areas, knowing that these companies had the ability to reinvest very large proportions of their earnings. Utilities whose operating environment dictated a larger cash payout rated lower prices. If, during this period, a high-grade, non-callable long-term bond with a 12% coupon had existed, it would have been sold far above par. And if it were a bond with a further unusual characteristic, which was that most of the coupon payments could be automatically reinvested at par in similar bonds, the issue would have commanded an even greater premium. In essence, growth stocks retaining most of their earnings represented just such a security. When their reinvestment rate on the added equity capital was 12%, while interest rates generally were around 4%, investors became very happy. And, of course, they paid happy prices. Looking back, stock investors can think of themselves in the 1946 to 66 period as having been ladled a truly bountiful triple dip. First, they were the beneficiaries of an underlying corporate return on equity that was far above prevailing interest rates. Second, a significant portion of that return was reinvested for them at rates that were otherwise unattainable. And third, they were afforded an escalating appraisal of underlying equity capital as the first two benefits became widely recognized. This third dip meant that, on top of the basic 12% or so earned by corporations on their equity capital, investors were receiving a bonus as the Dow Jones Industrials increased in price from 133% of book value in 1946 to 220% in 1966. Such a marking up process temporarily allowed investors to achieve a return that exceeded the inherent earning power of the enterprises in which they had invested. This heaven-on-earth situation finally was discovered in the mid-1960s by many major investing institutions. But just as these financial elephants began trampling on one another in their rush to equities, we entered an era of accelerating inflation and higher interest rates. Quite logically, the marking up process began to reverse itself. Rising interest rates ruthlessly reduced the value of all existing fixed coupon investments. And as long-term corporate bond rates began moving up, eventually reaching the 10% area, both the equity return of 12% and the reinvestment privilege began to look different. Stocks are quite properly thought of as riskier than bonds. While that equity coupon is more or less fixed over periods of time, it does fluctuate somewhat from year to year. Investors' attitudes about the future can be affected substantially, although frequently erroneously by those yearly changes. Stocks are also riskier because they come equipped with infinite maturities. Even your friendly broker wouldn't have the nerve to peddle a 100-year bond, if he had any available, as safe. Because of the additional risk, the natural reaction of investors is to expect an equity return that is comfortably above the bond return, and 12% on equity versus, say, 10% on bonds issued by the same corporate universe does not seem to qualify as comfortable. As the spread narrows, equity investors start looking for the exits. But, of course, as a group they can't get out. All they can achieve is a lot of movement, substantial frictional costs, and a new, much lower level of valuation, reflecting the lessened attractiveness of the 12% equity coupon under inflationary conditions. Bond investors have had a succession of shocks over the past decade in the course of discovering that there is no magic attached to any given coupon level. At 6% or 8% or 10%, bonds can still collapse in price. Stock investors who are, in general, not aware that they too have a coupon are still receiving their education on this point. Must we really view that 12% equity coupon as immutable? Is there any law that says the corporate return on equity capital cannot adjust itself upward in response to a permanently higher average rate of inflation? There is no such law, of course. On the other hand, corporate America cannot increase earnings by desire or decree. To raise that return on equity, corporations would need at least one of the following. 1. An increase in turnover, i.e., in the ratio between sales and total assets employed in the business. 2. Cheaper leverage. 3. More leverage. 4. Lower income taxes. 5. Wider operating margins on sales. And that's it. There simply are no other ways to increase returns on common equity. Let's see what can be done with these. We'll begin with turnover. The three major categories of assets we have to think about for this exercise are accounts receivable, inventories, and fixed assets such as plants and machinery. Accounts receivable go up proportionally as sales go up, whether the increase in dollar sales is produced by more physical volume or by inflation. No room for improvement here. With inventories, the situation is not quite so simple. Over the long term, the trend in unit inventories may be expected to follow the trend in unit sales. Over the short term, however, the physical turnover rate may bob around because of special influences, e.g., cost expectations or bottlenecks. The use of last in, first out, LIFO, inventory valuation methods serves to increase the reported turnover rate during inflationary times. When dollar sales are rising because of inflation, inventory valuations of a LIFO company either will remain level if unit sales are not rising, or will trail the rise in dollar sales if unit sales are rising. In either case, dollar turnover will increase. During the early 1970s, there was a pronounced swing by corporations toward LIFO accounting, which has the effect of lowering a company's reported earnings and tax bills. The trend now seems to have slowed. Still, the existence of a lot of LIFO companies, plus the likelihood that some others will join the crowd, ensures some further increases in the reported turnover of inventory. In the case of fixed assets, any rise in the inflation rate, assuming it affects all products equally, will initially have the effect of increasing turnover. That is true because sales will immediately reflect the new price level, while the fixed asset account will reflect the change only gradually, i.e., as existing assets are retired and replaced at the new prices. Obviously, the more slowly a company goes about this replacement process, the more the turnover ratio will rise. The action stops, however, when a replacement cycle is completed. Assuming a constant rate of inflation, sales and fixed assets will then begin to rise in concert at the rate of inflation. To sum up, inflation will produce some gains in turnover ratios. Some improvement will be certain because of LIFO, and some will be possible if inflation accelerates because of sales rising more rapidly than fixed assets. But the gains are apt to be modest and not of a magnitude to produce substantial improvement in returns on equity capital. During the decade ending in 1975, despite generally accelerating inflation and the extensive use of LIFO accounting, the turnover ratio of the Fortune 500 went only from 1.18 to 1 to 1.29 to 1. Cheaper leverage? Not likely. High rates of inflation generally cause borrowing to become dearer, not cheaper. Galloping rates of inflation create galloping capital needs, and lenders, as they become increasingly distrustful of long-term contracts, become more demanding. But even if there is no further rise in interest rates, leverage will be getting more expensive because the average cost of the debt now on corporate books is less than would be the cost of replacing it. And replacement will be required as the existing debt matures. Overall, then, future changes in the cost of leverage seem likely to have a mildly depressing effect on the return on equity. More leverage? American business already has fired many, if not most, of the more leverage bullets once available to it. Proof of that proposition can be seen in some other Fortune 500 statistics. In the 20 years ending in 1975, stockholders' equity as a percentage of total assets declined for the 500 from 63% to just under 50%. In other words, each dollar of equity capital now is leveraged much more heavily than it used to be. An irony of inflation-induced financial requirements is that the highly profitable companies, generally the best credits, require relatively little debt capital. But the laggards in profitability never can get enough. Lenders understand this problem much better than they did a decade ago, and are correspondingly less willing to let capital-hungry, low-profitability enterprises leverage themselves to the sky. Nevertheless, given inflationary conditions, many corporations seem sure in the future to turn to still more leverage as a means of shoring up equity returns. Their managements will make that move because they will need enormous amounts of capital, often merely to do the same physical volume of business, and will wish to get it without cutting dividends or making equity offerings that, because of inflation, are not apt to shape up as attractive. Their natural response will be to heap on debt almost regardless of cost. They will tend to behave like those utility companies that argued over 1/8 of a point in the 1960s and were grateful to find 12% debt financing in 1974. Added debt at present interest rates, however, will do less for equity returns than did added debt at 4% rates in the early 1960s. There is also the problem that higher debt ratios cause credit ratings to be lowered, creating a further rise in interest costs. So, that is another way to be added to those already discussed, in which the cost of leverage will be rising. In total, the higher cost of leverage are likely to offset the benefits of greater leverage. Besides, there is already far more debt in corporate America than is conveyed by conventional balance sheets. Many companies have massive pension obligations geared to whatever pay levels will be in effect when present workers retire. At the low inflation rates of 1955 to 65, the liabilities arising from such plans were reasonably predictable. Today, nobody can really know the company's ultimate obligation. But if the inflation rate averages 7% in the future, a 25-year-old employee who is now earning $12,000 and whose raises do no more than match increases in living costs will be making $180,000 when he retires at 65. Of course, There is a marvelously precise figure in many annual reports each year, purporting to be the unfunded pension liability. If that figure were really believable, a corporation could simply ante up that sum, add it to the existing pension fund assets, turn the total amount over to an insurance company, and have it assume all the corporation's present pension liabilities. In the real world, alas, it is impossible to find an insurance company willing even to listen to such a deal. Virtually every corporate treasurer in America would recoil at the idea of issuing a cost of living bond, a non-callable obligation with coupons tied to a price index. But through the private pension system, corporate America has, in fact, taken on a fantastic amount of debt that is the equivalent of such a bond. More leverage, whether through conventional debt or unbooked and indexed pension debt, should be viewed with skepticism by shareholders. A 12% return from an enterprise that is debt-free is far superior to the same return achieved by a business hucked to its eyeballs, which means that today's 12% equity returns may well be less valuable than the 12% returns of 20 years ago. Lower corporate income taxes seem unlikely. Investors in American corporations already own what might be thought of as a Class D stock. The Class A, B, and C stocks are represented by the income tax claims of the federal, state, and municipal governments. It is true that these investors have no claim on the corporation's assets. However, they get a major share of the earnings, including earnings generated by the equity buildup resulting from retention of part of the earnings owned by the Class D shareholders. A further charming characteristic of these wonderful Class A, B, and C stocks is that their share of the corporation's earnings can be increased immediately, abundantly, and without payment by the unilateral vote of any one of the stockholder classes, e.g. by congressional action in the case of the Class A. To add to the fun, one of the classes will sometimes vote to increase its ownership share in the business retroactively, as companies operating in New York discovered to their dismay in 1975. Whenever the Class A, B, or C stockholders vote themselves a larger share of the business, the portion remaining for Class D, that's the one held by the ordinary investor, declines. Looking ahead, it seems unwise to assume that those who control the A, B, and C shares will vote to reduce their own take over the long run. The Class D shares probably will have to struggle to hold their own. The last of our 5 possible sources of increased returns on equity is wider operating margins on sales. Here is where some optimists would hope to achieve major gains. There is no proof that they are wrong, but there are only 100 cents in the sales dollar and a lot of demands on that dollar before we get down to the residual pre-tax profits. The major claimants are labor, raw materials, energy, and various non-income taxes. The relative importance of these costs hardly seems likely to decline during an age of inflation. Recent statistical evidence, furthermore, does not inspire confidence in the proposition that margins will widen in a period of inflation. In the decade ending in 1965, a period of relatively low inflation, the universe of manufacturing companies reported on quarterly by the Federal Trade Commission had an average annual pre-tax margin on sales of 8.6%. In the decade ending in 1975, the average margin was 8%. Margins were down, in other words, despite a very considerable increase in the inflation rate. If businesses were able to base its prices on replacement costs, margins would widen in inflationary periods. But the simple fact is that most large businesses despite a widespread belief in their market power, just don't manage to pull it off. Replacement cost accounting almost always shows that corporate earnings have declined significantly in the past decade. If such major industries as oil, steel, and aluminum really have the oligopolistic muscle imputed to them, one can only conclude that their pricing policies have been remarkably restrained. There you have the complete lineup. 5 factors that can improve returns on common equity, none of which, by my analysis, are likely to take us very far in that direction in periods of high inflation. You may have emerged from this exercise more optimistic than I am, but remember, returns in the 12% area have been with us a long time. Even if you agree that the 12% equity coupon is more or less immutable, you still may hope to do well with it in the years ahead. It's conceivable that you will. After all, a lot of investors did well with it for a long time. But your future results will be governed by 3 variables: the relationship between book value and market value, the tax rate, and the inflation rate. Let's wade through a little arithmetic about book and market value. When stocks consistently sell at book value, it's all very simple. If a stock has a book value of $100 and also an average market value of $100, 12% earnings by business will produce a 12% return for the investor, less those frictional costs, which we'll ignore for the moment. If the payout ratio is 50%, our investor will get $6 via dividends and a further $6 from the increase in the book value of the business, which will, of course, be reflected in the market value of his holdings. If the stock sold at 150% of book value, the picture would change. The investor would receive the same $6 cash dividend, but it would now represent only a 4% return on his $150 cost. The book value of the business would still increase by 6% to $106, and the market value of the investor's holdings, valued consistently at 150% of book value, would similarly increase by 6% to $159. But the investor's total return, i.e. from appreciation plus dividends, would be only 10% versus the underlying 12% earned by the business. When the investor buys in below book value, the process is reversed. For example, if the stock sells at 80% of book value, the same earnings and payout assumptions would yield 7.5% from dividends, $6 on an $80 price, and 6% from appreciation, a total return of 13.5%. In other words, you do better by buying at a discount rather than a premium, just as common sense would suggest. During the post-war years, the market value of the Dow Jones Industrials has been as low as 84% of book value in 1974 and as high as 230% in 1965. Most of the time, the ratio has been well over 100%. Early this spring, it was around 110%. Let's assume that in the future, the ratio will be something close to 100%, meaning that investors in stocks could earn the full 12%. At least, they could earn that figure before taxes and before inflation. How large a bite might taxes take out of the 12%? For individual investors, it seems reasonable to assume that federal, state, and local income taxes will average perhaps 50% on dividends and 30% on capital gains. A majority of investors may have marginal rates somewhat below these, but many with larger holdings will experience substantially higher rates. Under the new tax law, a high-income investor in a heavily taxed city could have a marginal rate on capital gains as high as 56%, So let's use 50% and 30% as representative for individual investors. Let's also assume, in line with recent experience, that corporations earning 12% on equity pay out 5% in cash dividends, 2.5% after tax, and retain 7%, with those retained earnings producing a corresponding market value growth, 4.9% after the 30% tax. The after-tax return, then, would be 7.4%. Probably this should be rounded down to about 7% to allow for frictional costs. To push our stocks disguised as bonds thesis one notch further, then, stocks might be regarded as the equivalent for individuals of 7% tax-exempt perpetual bonds. Which brings us to the crucial question, the inflation rate. No one knows the answer on this one, including the politicians, economists, and establishment pundits who felt a few years back that with slight nudges here and there, unemployment and inflation rates would respond like trained seals. But many signs seem negative for stable prices. The fact that inflation is now worldwide, the propensity of major groups in our society to utilize their electoral muscle to shift rather than solve economic problems, the demonstrated unwillingness to tackle even the most vital problems, e.g., energy and nuclear proliferation, if they can be postponed, and a political system that rewards legislators with re-election if their actions appear to produce short-term benefits, even though their ultimate imprint will be to compound long-term pain. Most of those in political office, quite understandably, are firmly against inflation and firmly in favor of policies producing it. This schizophrenia hasn't caused them to lose touch with reality, however. Congressmen have made sure that their pensions, unlike practically all granted in the private sector, are indexed to cost of living changes after retirement. Discussions regarding future inflation rates usually probe the subtleties of monetary and fiscal policies. These are important variables in determining the outcome of any specific inflationary equation. But at the source, peacetime inflation is a political problem, not an economic one. Human behavior, not monetary behavior, is the key. When very human politicians choose between the next election and the next generation, it's clear what usually happens. Such broad generalizations do not produce precise numbers. However, it seems quite possible to me that inflation rates will average 7% in future years. I hope this forecast proves to be wrong, and it may well be. Forecasts usually tell us more about the forecaster than of the future. You are free to factor your own inflation rate into the investor's equation, but if you foresee a rate averaging 2% or 3%, you are wearing different glasses than I am. So, there we are. 12% before taxes and inflation, 7% after taxes and before inflation, and maybe 0% after taxes and inflation. It hardly sounds like a formula that will keep all those cattle stampeding on TV. As a common stockholder, you will have more dollars, but you may have no more purchasing power. Out with Ben Franklin, a penny saved is a penny earned, and in with Milton Friedman, a man might as well consume his capital as invest it. The arithmetic makes it plain that inflation is a far more devastating tax than anything that has been enacted by our legislatures. The inflation tax has a fantastic ability to simply consume capital. It makes no difference to a widow with her savings in a 5% passbook account whether she pays 100% income tax on her interest income during a period of zero inflation or pays no income taxes during years of 5% inflation. Either way, she is taxed in a manner that leaves her no real income whatsoever. Any money she spends comes right out of capital. She would find outrageous a 120% income tax, but doesn't seem to notice that 6% inflation is the economic equivalent. If my inflation assumption is close to correct, disappointing results will occur not because the market falls, but in spite of the fact that the market rises. At around 920 early last month, the Dow was up 55 points from where it was 10 years ago. But adjusted for inflation, the Dow is down almost 345 points, from 865 to 520. And about half of the earnings of the Dow had to be withheld from their owners and reinvested in order to achieve even that result. In the next 10 years, the Dow could be doubled just by a combination of the 12% equity coupon, a 40% payout ratio, and the present 110% ratio of market to book value. And with 7% inflation, investors who sold at 1800 would still be considerably worse off than they are today after paying their capital gains taxes. I can almost hear the reaction of some investors to these downbeat thoughts. It will be to assume that whatever the difficulties presented by the new investment era, they will somehow contrive to turn in superior results for themselves. Their success is most unlikely, and in aggregate, of course, impossible. If you feel you can dance in and out of securities in a way that defeats the inflation tax, I would like to be your broker, but not your partner. Even the so-called tax-exempt investors, such as pension funds and college endowment funds, do not escape the inflation tax. If my assumption of a 7% inflation rate is correct, a college treasurer should regard the first 7% earned each year merely as a replenishment of purchasing power. Endowment funds are earning nothing until they have outpaced the inflation treadmill. At 7% inflation and, say, overall investment returns of 8%, these institutions, which believe they are tax-exempt, are in fact paying income taxes of 87.5%. Unfortunately, the major problems from high inflation rates flow not to investors but to society as a whole. Investment income is a small portion of national income, and if per capita real income could grow at a healthy rate alongside zero real investment returns, social justice might well be advanced. A market economy creates some lopsided payoffs to participants. The right endowment of vocal cords, anatomical structure, physical strength, or mental powers can produce enormous piles of claim checks, stocks, bonds, and other forms of capital on future national output. Proper selections of ancestors similarly can result in lifetime supplies of such tickets upon birth. If zero real investment returns diverted a bit greater portion of the national output from such stockholders to equally worthy and hard-working citizens lacking jackpot-producing talents, it would seem unlikely to pose such an insult to an equitable world as to risk divine intervention. But the potential for real improvement in the welfare of workers at the expense of affluent stockholders is not significant. Employee compensation already totals 28 times the amount paid out in dividends, and a lot of those dividends now go to pension funds, nonprofit institutions such as universities, and individual stockholders who are not affluent. Under these circumstances, if we now shifted all dividends of wealthy stockholders into wages, something we would do only once, like killing a cow, or if you prefer, a pig, we would increase real wages by less than we used to obtain from 1 year's growth of the economy. Therefore, diminishment of the affluent through the impact of inflation on their investments will not even provide material short-term aid to those who are not affluent. Their economic well-being will rise or fall with the general effects of inflation on the economy, and those effects are not likely to be good. Large gains in real capital invested in modern production facilities are required to produce large gains in economic well-being. Great labor availability, great consumer wants, and great government promises will lead to nothing but great frustration without continuous creation and employment of expensive new capital assets throughout industry. That's an equation understood by Russians as well as Rockefellers, and it's one that has been applied with stunning success in West Germany and Japan. High capital accumulation rates have enabled those countries to achieve gains in living standards at rates far exceeding ours, even though we have enjoyed much the superior position in energy. To understand the impact of inflation upon real capital accumulation, a little math is required. Come back for a moment to that 12% return on equity capital. Such earnings are stated after depreciation, which presumably will allow replacement of present production capacity if that plant and equipment can be purchased in the future at prices similar to their original cost. Let's assume that about half of earnings are paid out in dividends, leaving 6% of equity capital available to finance future growth. If inflation is low, say 2%, a large portion of that growth can be real growth in physical output. For under these conditions, 2% more will have to be invested in receivables, inventories, and fixed assets next year just to duplicate this year's physical output, leaving 4% for investment in assets to produce more physical goods. The 2% finances illusory dollar growth, reflecting inflation, and the remaining 4% finances real growth. If population growth is 1%, the 4% gain in real output translates to a 3% gain in real per capita net income. That, very roughly, is what used to happen in our economy. Now, move the inflation rate to 7% and compute what is left for real growth after the financing of the mandatory inflation component. The answer is nothing, if dividend policies and leverage ratios remain unchanged. After half of the 12% earnings are paid out, the same 6% is left, but it is all conscripted to provide the added dollars needed to transact last year's physical volume of business. Many companies faced with no real retained earnings with which to finance physical expansion after normal dividend payments will improvise. How, they will ask themselves, can we stop or reduce dividends without risking stockholder wrath? I have good news for them. A ready-made set of blueprints is available. In recent years, the electric utility industry has had little or no dividend-paying capacity, or rather, it has had the power to pay dividends if investors agree to buy stock from them. In 1975, electric utilities paid common dividends of $3.3 billion and asked investors to return $3.4 billion. Of course, they mixed in a little solicit Peter to pay Paul technique so as not to acquire a Con Ed reputation. Con Ed, you will remember, was unwise enough in 1974 to simply tell its shareholders it didn't have the money to pay the dividend. Candor was rewarded with calamity in the marketplace. The more sophisticated utility maintains, perhaps increases, the quarterly dividend and then asks shareholders, either old or new, to mail back the money. In other words, the company issues new stock. This procedure diverts massive amounts of capital to the tax collector and substantial sums to underwriters. Everyone, however, seems to remain in good spirits, particularly the underwriters. Encouraged by such success, some utilities have devised a further shortcut. In this case, the company declares the dividend, the shareholder pays the tax, and presto, more shares are issued. No cash changes hands, although the IRS, spoilsport as always, persists in treating the transaction as if it had. AT&T, for example, instituted a dividend reinvestment program in 1973. This company, in fairness, must be described as very stockholder-minded, and its adoption of this program, considering the folk ways of financing, must be regarded as totally understandable. But the substance of the program is out of Alice in Wonderland. In 1976, AT&T paid $2.3 billion in cash dividends to about 2.9 million owners of its common stock. At the end of the year, 648,000 holders, up from 601,000 the previous year, reinvested $432 million, up from $327 million, in additional shares supplied directly by the company. Just for fun, let's assume that all AT&T shareholders ultimately sign up for this program. In that case, no cash at all would be mailed to shareholders, just as when Con Ed passed a dividend. However, each of the 2.9 million owners would be notified that he should pay income taxes on his share of the retained earnings that had that year been called a dividend. Assuming that dividends totaled $2.3 billion as in 1976, and that shareholders paid an average tax of 30% on these, they would end up, courtesy of this marvelous plan, paying nearly $700 million to the IRS. Imagine the joy of shareholders in such circumstances if the directors were then to double the dividend. We can expect to see more use of disguised payout reductions as business struggles with the problem of real capital accumulation. But throttling back shareholders somewhat will not entirely solve the problem. A combination of 7% inflation and 12% returns will reduce the stream of corporate capital available to finance real growth. And so, as conventional private capital accumulation methods falter under inflation, our government will increasingly attempt to influence capital flows to industry, either unsuccessfully, as in England, or successfully, as in Japan. The necessary cultural and historical underpinning for a Japanese-style enthusiastic partnership of government, business, and labor seems lacking here. If we are lucky, we will avoid following the English path, where all segments fight over divisions of the pie rather than pool their energies to enlarge it. On balance, however, it seems likely that we will hear a great deal more as the years unfold about underinvestment, stagflation, and the failures of the private sector to fulfill needs.
Addendum. A sidebar explaining who Buffett was, that's how unfamous he was in 1977, accompanied this article. Most of the details included there are now widely familiar, and we will not repeat them here. But we will report that Buffett's Berkshire holdings were then worth $35 million, and his blue chip stamps stake almost $10 million. And both of those companies were active investors as well. So why, the last paragraph of the box sensibly asked, does a man so gloomy about stocks own so much of them? Partly it's habit, Buffett answered. Partly it's that stocks mean business, and owning businesses is much more interesting than owning gold or farmland. Besides, stocks are probably still the best of all the poor alternatives in an era of inflation. At least they are if you buy in at appropriate prices. C.L. A small college scores big in the investment game. December 18, 1978. By Lee Smith. Grinnell College's remarkable Buffett-aided success with its endowment fund was a story not known nationally until Fortune published this article. The story describes an important component of this success: Grinnell's unorthodox purchase in 1976 of a television station in Dayton, and ends with Buffett's thought that it might be one hell of an asset to keep holding. But prices for stations continued to rise, and a short time later, Buffett was ready for Grinnell to exit. The station, bought only 4 years earlier for $12.9 million, only $2 million of that cash, the rest a non-recourse loan, was sold to Hearst in 1980 for $50 million. Joe Rosenfield, who persuaded Buffett to join the Grinnell board, stayed close to the college, an institution he loved until his death in 2000. Buffett remained as active trustee until 1987 and a lifetime trustee until 2011. He meanwhile harbored some doubts about his board experience. What bothered him the most was that the outsized gains he and Rosenfield attained for Grinnell's endowment, multiplying it more than 60 times, seemed otherwise not to lead to much. Today, Buffett says, it was a fine school with 1,200 students when it had an $8 million endowment, and it was a fine school with 1,200 students when it had a $500 million endowment. To bring Grinnell up to date, in its 2011-2012 year, it had about 1,600 students, and its endowment was around $1.5 billion. CL.
Grinnell College has always been a little bit improbable. Its 90-acre campus sits on the edge of a typical mid-Iowa farm community, where the tallest structure in town is the grain elevator, and where a college might be expected to emphasize the animal husbandry and go easy on the humanities. Not Grinnell. It offers its 1,200 or so students a rigorous, traditional curriculum based on such staples as American colonial history, the poetry of John Milton, and an introduction to quantum theory. It has thus earned a reputation as one of America's fine liberal arts colleges. These days, Grinnell is surprising for quite another reason. The little school in the Corn Belt has managed its endowment fund so adroitly that the fund has doubled in the past 5 years to $37.5 million, and that appraisal is conservative. If all its assets were marked up to their true market value, the total would be closer to $60 million. New contributions to the endowment have amounted to only about $5.4 million. The fund has grown mainly because of the stunning appreciation of its assets. Even using the conservative valuation, appreciation, along with income, has yielded for the fund an average total return of 16.2% annually over the last 5 years. During that same period, college and university endowments in general have fared dismally. The median return for the 150 endowment funds tracked by A.G. Becker in that 5-year period has been a meager 1.7% annually. To accomplish what it did, Grinnell employed investment strategies and ventured into enterprises that educational institutions normally shun. For example, rather than tuck its eggs cautiously into a variety of conventional baskets in the equity and bond markets, Grinnell has not hesitated to stash a lot of eggs in 1 or 2 baskets or to take a flyer on a speculative issue. Its most unusual and dramatic move was to buy a commercial television station for $12.9 million. The trustees of Grinnell, unlike those of many other schools, have not relinquished day-to-day control of the endowment to a bank or an outside portfolio manager or even to a professional in-house manager. They have deliberately kept it in their own hands, or, more precisely, they have entrusted it to their finance committee, principally to 2 members of the committee who have demonstrated their fitness for the job by having previously accumulated considerable fortunes for themselves. One is Joseph F. Rosenfield of Des Moines, a retired attorney and active investor who was once chairman of Yonkers Brothers, a prosperous department store chain operating in 5 Midwestern states. The second key member of the committee is Warren E. Buffett. Buffett achieved considerable fame as the Omaha investor who parlayed a small stake from family and friends into an investment partnership that grew to a phenomenal average annual rate, 29.5% over a 13-year period, and was worth $100 million by the time he liquidated it and distributed the profits in 1969. Through his own holdings, he still controls a substantial number of companies, including financial institutions and newspapers. When Rosenfield, class of 25, joined the board in 1941, the endowment was worth only about $100 million. It included a few farms the school had inherited and $2,500,000 in securities. The first windfall came in the early 1950s when the school was left about $5 million in assets from the estate of oilman Fred Darby. A second boost followed in the early 60s when the Ford Foundation promised that if Grinnell could raise $4 million on its own, Ford would contribute $2 million. Grinnell raised the money, with $400,000 coming directly from the pocket of Joe Rosenfield. Rosenfield has continued to contribute to the school, and most of his donations have been placed in a special kitty within the endowment that has come to be known as the J.F. Rosenfield Fund. It is into this fund that he and Warren Buffett have dipped to take some limited risks with small amounts of money that would not have yielded very much if they had been left in the traditional blue chip stocks and bonds. The two investors have been strikingly successful. The hypothetical share in the fund would have increased about 18-fold in the past 15 years. The Rosenfield Fund made its first spectacularly successful investment 10 years ago. Robert N. Noyce, one of the founders of Fairchild Semiconductor, was a Grinnell trustee and alumnus, having been a somewhat mischievous student who was once suspended for stealing a farmer's pig for a midnight barbecue. Rosenfield and another trustee, Chicago attorney Samuel R. Rosenthal, were far-sighted enough to recognize that Noyce's genius could be put to work for the college. "We told Bob that when he went into his own business, the college wanted part of it," Rosenfield recalls. And so, when Noyce left Fairchild in 1968 to form Intel, a company that would make tiny semiconductor memory chips for computers, he gave the college the opportunity to buy $300,000 worth of Intel convertible bonds. Rosenthal and Rosenfield each contributed $100,000. The final third came from the Rosenfield Fund. As Intel flourished, the school's investment increased in value about 46 times. The endowment fund converted the bonds and, over the years, has sold off most of its Intel stock at a profit of close to $12 million. It holds on to some 37,000 shares with a market value of about $2 million. Buffett is not a Grinnell alumnus. He attended the Wharton School and the University of Nebraska as an undergraduate, and later got a master's degree in economics from the Columbia University Graduate School of Business. He was persuaded to become a Grinnell trustee only because of Rosenfield, whom he had met through mutual friends. Although they are a generation apart, Rosenfield is 74 and Buffett is 48. The two are very close. And so, in 1968, at Rosenfield's request, Buffett joined the board. "Joe is not the kind of guy you can say no to," muses Buffett. "For one thing, he's the one guy I know who actually seems to take his net worth down with his contributions. Others just give to the limit of what's tax-deductible." The two men consult frequently with one another, sometimes with other members of the Finance Committee, especially the chairman, 38-year-old Tom Hutchison, a wealthy Des Moines investment counselor, but rarely with the entire 32-member board. Buffett, in particular, is a loner, restless at the daytime board meetings that are held 3 times a year at the Grinnell Library, and impatient with committee proceedings. Buffett's and Rosenfield's investment strategies are similar, but one may be more enthusiastic about an idea than the other. During the Intel purchase, for example, Buffett stood quietly on the sidelines. "I wasn't against it," he explains. It's just that I don't understand the semiconductor business, and I don't go into businesses that I can't understand that my sister can't understand. Buffett is at heart a disciple of Benjamin Graham, under whom he studied at Columbia, and as such, he believes in seeking out an undervalued company and investing in it heavily. Buffett, in fact, carries the Graham philosophy even further than Graham himself. For Graham was willing to sell out when the price of the stock rose to what he considered its true value. Buffett prefers to buy stocks that he will want to hold indefinitely. These days, his notion of an ideal opportunity is to buy into a business for $100 million when it is really worth $2 million and will be worth $4 million in 5 years. Such situations, he acknowledges, are not easy to find. We don't have a lot of good ideas, he says, and therefore we don't do a lot of things. Buffett found Grinnell's main chance almost by accident in 1976. During a conference on newspaper economics in New Orleans, Thomas S. Murphy, chairman of Capital Cities Communications and a friend of Buffett's, mentioned to him over breakfast that Avco Corp was selling its television stations. Buffett would have been interested in buying a station for himself, or Berkshire Hathaway, a company he controls, were it not for a possible conflict of interest. Berkshire Hathaway owns 12% of the Washington Post Company. Any one owner is limited to 5 television stations, 7 if at least 2 are the less desirable UHF stations. The Post Company already owns 4 VHF stations. It was conceivable that, even though Berkshire's stock in the Post is not voting stock, the government would count a purchase of the Avco station by either Buffett or Berkshire in the Post's column, using up the Post's last bullet, so to speak. He was about to forget about the idea when, during a telephone conversation with Rosenfield, it suddenly occurred to him that a television station might be just the thing for Grinnell. Because of cash problems, Avco was willing to dispose of the stations, and so Grinnell was likely to acquire just the sort of solid, undervalued asset Buffett prizes. It was not unheard of for a college to own a television station. The leading commercial television station in New Orleans is a division of Loyola University. But it was extraordinary for a college to go out into a market and bid on one. The board went along, but there was so much delay while they discussed how they were going to finance the purchase that Grinnell lost out on its first choice, Avco's Cincinnati station, which Multimedia Incorporated bought for $16 million. Grinnell managed to salve its disappointment by quickly purchasing $350,000 worth of Multimedia stock, which has since tripled in value. In the second attempt, aimed at Avco's Dayton station, Buffett decided simply to plunge ahead and worry about the financing later. He offered $12.9 million for station WLWD-TV2, an NBC affiliate, a price that represented about 2.5 times the station's gross revenues. Not overly generous in view of the fact that stations often sell for at least 3 times revenues. But Avco accepted. The station, housed in a converted roller skating rink just outside the Dayton city limits in Moraine, Ohio, is the number 2 station in a 3-station market. Grinnell changed the call letters to WDTN and formed a separate company, Grinnell Communications, to run it. The company pays corporate income taxes on its earnings, just as it would if it were owned by an organization run for profit rather than education. Grinnell Communications invested about $1.3 million in capital improvements, including $750,000 to double the height of its broadcast tower and thereby expand its audience. Running the station has presented little problem so far. Ray W. Coley, general manager of the station under Avco, has stayed on to operate it under Grinnell, and although the company's 6-member board is dominated by Grinnell trustees, they leave Coley and his staff pretty much alone. As the station was ultimately financed, the Rosenfield Fund supplied $2 million in equity and Grinnell borrowed the other $11 million, half from outside lenders and half from the endowment fund itself. The truly noteworthy aspect of the investment has been its impressive appreciation. Television stations in the top 50 markets, Dayton is number 46, have sold recently for as much as 4 times revenues. WDTN expects revenues of about $9 million this year, which means it likely has a market value in the neighborhood of $35 million, more than 2.5 times what the school paid for it. The value of the station is understated considerably on Grinnell's books. The original $2 million equity investment is shown at cost, along with about $5 million in debt still owed the endowment. Some of the debt has been paid off. That $7 million would rise dramatically if WDTN were accounted for realistically, at its market value less the $4.7 million debt still owed to the outsiders. The value of the endowment would then be closer to $60 million than the $37.5 million at which Grinnell appreciates it. Buffett believes there is no reason why even large schools with immense endowments cannot adopt the same strategy that he has applied at Grinnell, limiting the portfolio to relatively few areas. That certainly leads to some fascinating possibilities. What if Harvard had been able to acquire control of American Broadcasting Company at the start of 1978, when the market value of the stock was about $700 million, half the size of Harvard's endowment? As fanciful as the idea is, a $700 million investment in ABC would have given Harvard a commitment to broadcasting roughly proportional to Grinnell's. It seems highly unlikely that any large school is going to move quite as boldly as Grinnell. In fact, even some of Grinnell's trustees are beginning to worry about the imbalance of their portfolio. Paradoxically, the more WDTN appreciates in value, the more uneasy they get. Their discomfort is understandable enough. The station now accounts for somewhere around half of the real wealth of the endowment, and there is a question as to whether it is prudent for a fiduciary to permit such a concentration. I can envision a situation in which the value of the station goes down, says one Grinnell trustee, and a student brings a class action against us, claiming that his tuition would have been lower if we had sold the station. Buffett says that, of course, if the trustees want to sell the station eventually, it is their right to do so. Clearly, however, he would be reluctant to vote in favor of such a sale, at least for now. I am always re-evaluating things, he says, and pauses. But that's one hell of an asset. When Buffett looks into the future, he focuses not on the chance of a lawsuit, but on another possibility. He sees a school that owns perhaps a cluster of businesses worth 20 times more than the amount of the operating budget. With a 5% real return on that investment, the school could be perpetually funded by its endowment. A school, in short, with no tuition at all.
Berkshire's shareholder contributions. Departing from our largely chronological format in this book, we pair 2 articles that are related. The first, from 1981, describes a Buffett innovation through which Berkshire shareholders were able to designate charities to which the company made gifts. The second, published 22 years later, reports Buffett's decision to close down the program because it had angered the opponents of abortion, who believed it favored pro-choice charities. Their ire was certainly not based on the range of charities that received contributions. Among the designees in 2002, for example, were 790 schools and 437 churches and synagogues. Reporting those numbers in his chairman's letter, Buffett also addressed the abortion issue and said he thought Berkshire's shareholders were probably on both sides of it in roughly the same proportion as the American population. But both Buffett and his late first wife Susie, and also Berkshire's vice chairman Charlie Munger, another very large shareholder, were known to be pro-choice in their thinking. So the pro-life forces assumed that charities they didn't wish to see flourish, such as Planned Parenthood, were getting a disproportionate share of the total contributions. The Buffett's contributions to, say, Planned Parenthood would have flowed through their foundation, of which I am a director. The pro-life opposition did not sway Buffett when the anger was aimed mainly at him and Munger. But it then began to be focused on a Berkshire subsidiary, Pampered Chef, and the independent consultants, mostly housewives, who sold its kitchen goods. It seemed unfair to Buffett that these women should lose their livelihood because of the Berkshire Contributions program, so he closed it down. Over its 22-year history, the program, a sort of charitable dividend, had dispensed $197 million and pleased many a shareholder. With the program's end, many Berkshire holders no doubt increased their personal gifts to charity. It seems likely, though, that these increases did not entirely offset the disappearance of Berkshire's contributions, and that total shareholder giving therefore declined. C.L. Shareholders Get to Vote on Charity, November 30th, 1981, by Lee Smith.
Unconscionable as it may seem, large corporations usually deprive their shareholders of the right to vote on which charities the companies give money to. Management decides where most of the dough will go. Employees get their say by using increasingly popular matching gift plans, but owners, for the most part, remain disenfranchised. That inequity for the people who hold equity has long bothered Warren E. Buffett, a noted investor and chairman of Berkshire Hathaway, Inc. So last month, Buffett gave Berkshire Hathaway's shareholders the right to distribute about $2 million to the colleges, churches, museums, social agencies, and other nonprofit organizations they believe in. I wouldn't want shareholders to write checks on my bank account for charities of their choice, he says. So I feel it inappropriate to write checks on their corporate bank account for charities of my choice. As Buffett sees it, most corporate managers give reflexively to whatever causes their peers support. Buffett, 51, is one manager who goes his own way. Barely out of college, he formed a partnership with friends and relatives and raised $100,000. Adding new capital from time to time, he ultimately parlayed the fund into $100 million in the stock market. In 1965, he took over and reorganized Berkshire Hathaway, which controls, among other things, See's Candies, Blue Chip Stamps, and a dozen insurance companies. It also owns 5% of General Foods and 13% of the Washington Post Company. Earnings are sizable, $53 million, or 51.72 cents a share last year. The stock currently sells over the counter for around $500 a share. Berkshire Hathaway hasn't paid a dividend since 1967, but net worth has grown an average of 20% a year. Despite its wealth, the company has given relatively little to charity, $200,000 or so a year. That's little more than 2% of 1980's pre-tax profits versus contributions averaging 1% for U.S. companies in general. Buffett was tight-fisted because he didn't know how to improve on the methods other big corporations used to choose recipients. His new scheme, he thinks, is both fair and practical. It imitates closely held corporations that poll shareholders on their preferences. But instead of polling a dozen or so shareholders, Buffett is contacting 1,500. The ballots go in the mail this month. With some 1 million shares outstanding, each share gives its owner the right to allocate $2 to charity. A shareholder with 1,000 shares, in other words, can instruct the company to send out $2,000. The most important shareholders by far will not have to be polled. Buffett and his wife own 47% of the company and will be able to assign $935,000 to their favorite charities. The money will go initially to the Buffett Foundation, established 15 years ago, and then to organizations promoting birth control. Buffett's plan has tax advantages. Berkshire Hathaway could pay shareholders dividends, which they, in turn, could pass along to charity. But before profits are distributed to shareholders, they are taxed. Corporate charitable contributions, on the other hand, are treated as business expenses and are not taxed. So, every dollar that leaves Berkshire Hathaway's coffers, more goes to charity and less to the taxman. At first glance, Buffett seems to be inviting a blizzard of paperwork that will bury the 5-member staff at his 4-room corporate office in Omaha. Buffett's shareholders will send in forms giving the names and addresses of up to 3 charities to receive contributions. If a designated recipient is not obviously tax-exempt under Internal Revenue Service rules, Buffett's staff will ask for proof. What's obviously a charity to a widow in Winnetka might not be so obvious to Buffett. The staff will also have to verify the number of shares owned, make out the checks, and mail them, along with notes explaining that the gifts are being sent at the shareholder's request. Each shareholder must swear that the gift fulfills no other pledge he has made, or the IRS could treat the money as a dividend and increase Berkshire Hathaway's taxes accordingly.